You know, it's more important than ever for parents to think about saving for college because of the huge student loan burden that's hitting a lot of students these days. Many people are referring to student loans as the next financial crisis in waiting. Any money that you can set aside, no matter how little it may be, is a step in the right direction to keep your children from potentially being part of that crisis when it hits. One simple way to save for college is to set up a custodial account for your child. Basically what that involves is opening a financial account for your child that has your child's name on it as well as the name of one or both parents. The custodial account gives the parents control over the account until the child reaches the age of majority. In most states 18, in some states 21. One problem with custodial accounts, and one reason why a lot of parents don't like to go in that direction, is that once money is in a custodial account, the parents can't take it back out for their own purposes. From a legal perspective, that money belongs to the child at that point. And even though parents have control over the money, they're legally required to use it for the benefit of the child. In addition, when the child turns 18, or whatever the age of majority is in the state where you live, the child is legally entitled to that money, regardless of whether they intend to use it for college or for any other purpose. A lot of parents are not comfortable with that kind of flexibility, and so they prefer other options. One alternative that parents consider when they choose not to do a custodial account is to consider what's called a Coverdell Education Savings Account. Now that's a long name, it sounds complicated, but really it closely resembles what an IRA does for retirement. Parents put money into the Coverdell, they're allowed to invest it in pretty much whatever they want, and as long as that money eventually goes towards educational expenses for their child, any income that it produces comes out on a tax-free basis. So it's actually a really good deal. It's a better deal than a custodial account, which doesn't usually have very many tax advantages. One problem with the Coverdell, however, is that you're not allowed to contribute very much compared to the high cost of tuition these days. The current annual limitation is just $2,000. And next year, if there are no legal changes, that limit will drop to just $500. That's such a small amount that for many people, the hassle of setting up a Coverdell doesn't justify the minimal benefits. As a result, one of the more popular ways to save for college and still get some tax benefits has become very attractive, and that is called the 529 plan. 529 plans are named after a section of the tax code that makes them possible. And basically what they entail, they look a lot like a 401k plan does for people saving for retirement. States set up 529 plans that you are then allowed to participate in. The state decides what investments are available in each plan. Now, even though your state will have a plan, you're not required to stay inside your state. You can use any plan from any of the 50 states that offer them. The choice is yours, and you're able to take each of the plans and compare them and decide which ones have the investment options and the most attractive features that you like. Because there are so many 529 plans to choose from, it can be really intimidating to try to figure out which ones are best. In addition, a number of 529 plans come with very high fees. And so you have to be on the lookout to make sure that, especially if your state's plan happens to be one that has high costs, that you make sure that you find alternatives that allow you to keep more of your money to save for your children and have less money go to Wall Street and the institutions that are managing that money on your behalf. You know, because of all the complexities involved in all of these choices that you have, one choice that a lot of parents make is simply to set money aside in their own account and know for themselves that that money is earmarked for college. That system works pretty well, but it doesn't take advantage of all of the tax advantages that are available to the other methods. Another complication that you have to think about when you're thinking about saving for college is the impact that your savings will potentially have on your child's financial aid packages. Financial aid forms have become almost as complicated as tax forms, and so figuring out eligibility has become more and more difficult over time. Depending on which of these choices you pick can actually have a big impact on the aid package that your child gets. For instance, with custodial accounts, a lot of colleges will treat that money as belonging to the student rather than to the parents. And as a result, your child may end up having to foot more of the bill for tuition than if you use an alternative savings method like a 529 plan. In general, as with most investing questions, the sooner you start investing and saving for college, the easier it will be to accumulate enough money to cover the amount of expenses that you want to. The more time that you let your money grow, the greater the chance that you'll be able to make your child's life a lot easier when it comes to making sure that they can afford the college that they want to go to. One challenge that comes up for parents is that usually at the same time that they're thinking about saving for college for their kids, they're also becoming increasingly focused on setting money aside for their own retirements. And so trying to balance those becomes a big question for them. In general, parents should be sure not to give up their retirement savings in order to help their kids save for college. But if you can do both, obviously that's the best alternative. Pretty much whatever choice you make about how you decide to save for college, it's important to pick one and go with it, because the impact that it can have on your child's life is so huge and just getting bigger and bigger every day.